Hey everybody, thank you for being here. I'm glad everybody could join us. A happy Sunday. I hope everybody's having a good weekend, or as I like to call it, the two work days between Friday and Monday. We're doing these live streams every Sunday now from, I think I've got it down to 1 p.m. Eastern. I think that's working for a lot of people and not conflicting with a lot of other schedules, but let me know if you'd like to see different times. We're looking at maybe Saturday or Sunday. But it's just a great opportunity to reach out and talk to the community and get this kind of back and forth kind of idea and really talk about talk about that creating that financial future that we talk about on the channel so much. There's going to be a very special live stream. I talk about stocks and investing and my background as an equity analyst a lot, but we've never really covered that deep analysis that goes into professional stock picking. What those Wall Street analysts do and how they find some of those stocks to recommend and how they put together those estimates. But I asked in our last video if you wanted to see that more detailed and in-depth analysis. You answered overwhelmingly yes. So I'm going to fit as much as we can into this live stream today. But I'm also going to be putting out a series of videos on financial statement analysis, fundamental analysis, and really what goes into actual Wall Street analysis of stocks, how they pick stocks, and how you can use that to make better decisions and really just be a better investor. So we're going to get started here. I see some people joining. Thank you for being here. I appreciate you being here, taking part of your day to be here with us. What we're going to cover today is we're first going to cover some community and channel shout outs, some comments that I got over the last week that I want to point out, as well as shouting out some channels that are also great channels to follow here on YouTube. But then we're going to talk about some of the videos we covered last week and this next week to coming. It's all about investing. I've obviously, like I said, I come from that equity analyst background. Started in real estate analysis in college, but then quickly moved on to working with venture capital and portfolio managers. And I love talking about investments. So you'll probably see I'm a little bit more enthusiastic this week than maybe last week. Although I love talking about making money. But this is where I come from, and this is a great place to be for me. And then we're going to talk about that fundamental analysis. We're going to talk about really how to find those stocks, how to look deep into the financial statements, and really see what a lot of people aren't seeing, because 99% of what you see on TV, on blogs, on CNBC, it's not really what investing is all about. An analyst might come on there and give a couple of quick stock picks and a couple of talking points, but it's all that quick bullet point mentality that that's not stock picking. That's not professional analysis. When they go back to their office and they're spending 60, 70, 80 hours a week looking into these financial statements, calling their suppliers, calling their contacts, and even reaching out to management, because management gives a lot of time, a lot of face time to these analysts. I'm going to show you exactly what they do and what they watch for. And it's interesting, some of the stories that you come across as an analyst and some of the shenanigans that people, that companies and management try to pull to fool investors. It'd be funny if it wasn't tragic, and if it didn't lose a lot of people a lot of money. So we're going to do a lot of that. James, Ocean Mist, thank you for being here. Freedom Lover, Max, thank you for being here. But yeah, and for example, one of those stories I was covering this is quite a while ago, but I was covering a company called MicroStrategy Software, and it was a smaller company, but they came out with this press release that they were, they had a huge contract coming up. And if you looked back a couple of weeks, they'd actually just announced a joint venture with NCR, which is a NCR Corporation, $20 million investment in NCR, which of course, and we'll talk about this, that doesn't go on the income statement. So that $20 million they invested in NCR doesn't it doesn't count as expenses, so it doesn't hurt their earnings during that quarter. It comes out on the cash flow statement, which is what we'll be talking about today. Well, so lo and behold, a couple weeks later they announced this huge contract worth 19.5 million in sales to this one company, to NCR, their new best friend. So if you looked at this and you said, oh, well, just a minute, they just gave NCR $20 million investment, and then NCR turned around and bought $19.5 million worth of their stuff. But the way the financial accounting works, the $20 million investment didn't hit them on expenses, so it didn't lower their earnings. But of course, that $19.5 million came back, and that's sales, so that's higher earnings, and it's a smaller company, so that $19.5 million was pretty material. So basically, they were trying to kind of hide the fact that basically they were just moving money around, not doing anything extra, and we're getting these great sales and great earnings. So these kinds of shenanigans are everywhere. Companies management tries to pull this over on investors, and you really need to know where to look and how to look for it if you're going to see through some of these lies, really, and accounting tricks that companies try to do. So that's mostly what we'll be talking about today after we talk about some of those other things, and then of course we'll get to Q&A at the end. I appreciate everybody being here. If I don't see your question in the live stream during the live stream, because it's hard to jump back and forth with my notes and the chat, then go ahead and ask it in the Q&A. I try to hit every question and answer that gets asked. So Mr. Personality, Seti Nash, thanks for being here. With your wife for sharing your information for free with us. This is my life. I like I said, I come from an equity analyst background. I spent 10 years working with venture capital firms, portfolio managers, as an economist, as an analyst, and it's just what I like doing. I'm at a point in my in my career where I can just basically just kind of talk to you guys and do these videos because I've made enough money as an equity analyst and some of my other wealth hacking side hustles and that kind of thing. So yeah, it's kind of a nice financial freedom to have, to be able to just kind of create a YouTube channel and talk with everybody. So we're gonna get started here. Like I said, we're gonna cover some community and comments, shout outs, some channels, some great channels to follow. Talk about some of the investing videos we've got, and then we're going to get right into that fundamental analysis, because it's going to be an exciting video. I'm going to be covering some really interesting stuff that you never see on CNBC or these blogs, basically because you can't fit it into a soundbite. But it is going to make you a better investor, and it is going to show you how to pick stocks better. So I want to first, shout out to some of the comments, some of the community members I got over the past week. Got a comment from Edward Howell talking about how he did want to see some of this analysis to pick stocks, and wondered if I could look at the CAN SLIM stock picking strategy. Now you see a lot of these stock picking strategies that are kind of boiled down, and the CAN SLIM specifically it's interesting, but it's not enough. A lot of these slimmed down strategies are just kind of touching the surface of what you really need to look for. Basically, CAN SLIM is just starts off with looking at some earnings and sales stuff, and then goes into kind of like Porter's 5 forces, which, if you don't know, it's kind of assessing the competitive landscape for an industry. So what are the competitors? What's the macro environment? Stuff like that. And this is all a good place to start, but you really do need to dig deeper into the financial statements, the cash flows, things like that, things that we'll be covering in this video today in the live stream. And you can't spend too much time on these boiled down strategies because they're not real. They won't get you anywhere. Okay. The next one is by G. Stroud. Wanted to highlight his comment because he brought up a very good point that we had talked about in the penny stocks that I actually had missed. And he said he stays away from OTC and pink sheet penny stocks, which is absolutely correct. There's penny stocks trade on different exchanges, right? Some of them will trade on NASDAQ, just like regular stocks. Some of them will trade on OTC, which is the over-the-counter, and some will be pink sheets. And the difference is kind of might seem like semantic. You still buy them on online trading platforms and stuff like that, but they're very much different. These OTC, or the over-the-counter, and the pink sheet stocks are very much less regulated, and there's much less oversight and reporting that they need to do. So basically, you get legitimate companies that trade on the NASDAQ, the penny stocks or otherwise, they have to report, every quarter, every 3 months, they have to report their finances. They get audited by a separate and independent accounting firm, whereas a lot of these others, these OTC and pink sheet companies, they don't have a lot of those requirements. So, anytime you watch a movie about like Boiler Room or Wolf of Wall Street, right? They're always talking about these pink sheet stocks. If you remember Wolf of Wall Street, one of the first scenes when he actually goes and first starts working with that penny stock company, then the guy's like, oh no, these are all pink sheet stocks, and he asks him about it. Well, what do you know about this company? He says, I don't know. Half these stocks are dog shit anyway. But who knows? It's all pink sheet, and they've got so few reporting requirements. Nobody really knows a whole lot about them. They could be like in the movies, somebody's shack, somebody's garage in their backyard, and it's really hard to know with a lot of these. So definitely, if you're looking at penny stocks, and we'll talk a little bit about that video, definitely stick with the ones that are trade on the NASDAQ, and whenever you look at those, you're going to look on your online trading platform or on Yahoo Finance or whatever, and it'll say NASDAQ, or it'll say OTC, or it'll say something like that. So you want to look for stocks trading on the NASDAQ, just to make sure they've got a little bit more of those regulatory and reporting requirements. And of course, you always want to look at the financial statements and kind of do a little bit more research, which is like I said, what we'll talk about today. So we've got that. Now I want to call out a couple of channels, a couple of great channels here on YouTube to follow. First, Brian. Brian runs a kind of a making money site, online entrepreneurship, he calls it, and it's just a really great channel for finding those online side hustles, those kind of things. 15,000 subscribers, so he's doing really well. And you'll see a lot of these, a lot of these videos are online entrepreneurship, mistakes entrepreneurs make, and then the best videos, the ones I like the most, are just those how to make money. Those strategies that he's tried, and the ones that I love, things like that. So check out Brian's channel. Another channel I want to point out is Dennis Truffin. He runs the True Financials channel here on YouTube. I know Dennis from a financial bloggers conference. Great guy, and some really excellent excellent videos on budgeting, paying off debt, stuff like that. Some of the stuff that I like to cover on the channel a little bit, but we really don't get to it so much because I'm so much more excited about investing and making money. So a lot of those ideas on budgeting and watching your money and stuff like that. So check out Dennis's channel. It's True Financials. He actually does a live stream every Sunday at 2 p.m. Eastern. So directly after this, if you want to check that out, he'll be live pretty soon. So now what I want to do, we're going to get to those that financial statement analysis and what analysts actually do to pick stocks. But I want to cover, talk real quick about last week's videos, this next week's videos, and like I said, it's all about investing. We're doing investing for about 2 weeks here, and some really interesting ideas. We did institutional buyers and penny stocks last week. The penny stocks video on Friday is over 7,500 views in 2 days. It's our fastest ever, so definitely a hot topic, and some great upside, some great potential in these penny stocks. But you have to know how to pick them, how to do some of this analysis that we'll talk about today, because like I said, even if they are traded on the NASDAQ, so they've got those financial reporting requirements and that auditing requirement. There's a lot of stuff that you just don't see, and we're going to talk about some of the ways that they can try to trick investors, and you have to try to get over that. So I'm actually linking to the penny stocks video in the video description to this to our live stream. Check that out because I show you a screener on how to start finding penny stocks, and then some ideas, as well as sharing three penny stocks that I've been watching and a couple that I've been investing in lately as well. Next week, we've got our portfolio update. So our 2019 stock market challenge dividend portfolio that I've been running on M1 Finance, it's up 24% so far over the first 3 months, which I'm excited about because the stock market's up about 14%. So we're beating the market by about 10%. That's Monday's video, so that's tomorrow. I'm going to be updating you on the portfolio, and talking about the efficient market hypothesis. And before you yawn and fall asleep there, sorry, I got to get a little bit nerdy on you, but this efficient market hypothesis just says that you can't beat the market, right? It's a theory that all the information that we have about stocks and companies is immediately reflected in prices, and there's just so many people that are following this and chasing stocks and stuff that nobody really has an advantage. And I think with that portfolio beating the market there, and some of the stuff that we're going to talk about today, it's clearly busted. That you can use some of this fundamental analysis that we're going to be talking about today, some of these tricks and financial statement analysis to actually find out a little bit more than what the average investor has. So I'm excited about that video tomorrow. I'm also going to be sharing a video Wednesday on the investing sites I use. A lot of people have been asking about that, and a lot of people think, okay, well, I've got an E-Trade account or I've got an Ameritrade account. Why do I need more? Well, there's a lot of different reasons. I use M1 Finance for no cost investing, so I save a lot of money on the fees there. I use E-Trade for research because I get access to like Credit Suisse and Morningstar and a lot of other tip ranks, a lot of other research there. I use Ally Invest for just that broad financial access, a bank account, checking, bill pay, a lot of those other things. So there are reasons to use other accounts. So I talk about the 5 investing sites I use and why, and just besides the fact that a lot of these will run bonuses for signing up. So each year you look for some of the bonuses out there, open a new account, get maybe $500 free, and maybe you close it out in a year or two and transfer it to another account. But that's $500 free money for basically doing nothing. So I talk about that, and then Friday we've got a video on long-term investing. Picking stocks that are going to be there for 30 years or more. So I'm going to be looking at long-term macro trends and how to really kind of spot some of those. But I see a lot of people on the call. I appreciate everybody being here. We're going to get to that Q&A at the end, and I love just being able to share this. But I want to get to that fundamental analysis. The reason why we had this video today, like I said, I asked in our penny stocks video if you wanted to see this deeper view at how professional analysts, how Wall Street analysts pick stocks, and you said you did, and I'm excited because this is something that I don't get to talk about a lot anymore, that deeper financial statement analysis. Now, I do want to say that you don't need to do this. We're going to be talking about some pretty deep analysis into the financial statements, looking at press releases put out by companies, looking at their statement of cash flows. And this is something that analysts do 60, 80 hours a week. There is no 40-hour work week for your average analyst. And you go blind for the first 2 years making cash flow models. It's pretty detailed and it's intense. But you don't have to do that to invest. If you don't want to, you're just investing in funds like we talked about in that Vanguard fund portfolio video that we had. Spread your money out over five or six Vanguard funds to get that diversification, and you'll be fine. What we're talking about here is going a little bit further. Put in a couple hours a week to actually dig into those financial statements and what we'll be talking about, and like we're doing with that 2019 stock market challenge, beating the market by 10% so far in the first 3 months. Another important note that I want to make here is that if you're doing this financial statement analysis, and this is really how it's done by analysts on Wall Street, you need to focus on a specific sector or industry. Okay, you can't just say, okay, this week I want to find a tech stock, and this week I want to find a consumer staples stock or a utility company. It doesn't work that way, because what happens is you need to know the ins and outs of this industry to really know how the competitive forces are shaping up, how other companies are making money, how a specific company is doing, the trends in the industry. So what that means is, and how it works on Wall Street with analysts, they'll cover maybe one sector or a few industries in the sector. So sectors are broader parts of the economy, like consumer staples, which are things you have to buy, food, household goods, stuff like that. Consumer discretionary, which is stuff that you buy, clothes, but you don't necessarily need it. though you kind of need clothes, right? Utility companies, energy companies, that's a sector. Within each sector is industries, so very, very much more specific. So within consumer discretionary, those things you need, one industry would be like retail apparel. So that retail clothes like the Gap and Old Navy and stuff like that. Within utilities would be like the regulated utilities, the alternative energy companies. Those would be industries. So what a lot of analysts will do, a lot of them will have worked in that industry for a while and then come over to be an analyst covering stocks in that industry or that sector. And why this is important, like I said, and this is something that Peter Lynch made famous in invest in what you know. And find those 2 or 3 industries or sectors where you have deep experience, deep professional knowledge. You know how that industry works, how they make money, and more so than the average investor. You're going to be able to look at these financial statements and look at these press releases put out by the companies, and you're going to be able to spot the financial shenanigans, the tricks that they're trying to pull, and you know which ones are best of breeds. So what you do is you're going to be investing in a handful of stocks from those sectors after doing your analysis and your financial statement analysis and all that. You're going to pick a few of the best breeds from that industry. The rest of the money, you're just going to put in those broad index funds, right? So you're going to get market exposure. So you get market returns from maybe half or 50 or 60% of your portfolio, but then you pick these industries or these stocks within these industries that are best of breed that you know about for that extra solid return. Okay, so that's really how this all works on Wall Street. So we got a few more people. Susan, wanted to call out. Hey guys, good. Thank you for being here. Dennis from True Financials and Kelly from Freedom in a Budget. Thanks for coming out. So we're just getting into our financial statement analysis, and what I want to do now is kind of look at what an analyst is looking at when he gets into these financial statements, and really what you can look for really quickly to be able to tell what's going on with a stock. Now of course, I'm not saying that you have to become an accountant or a numbers nerd like me. You just have to know, some quick places to look and why, really kind of that mainstream media investing is really not how analysts actually do it. So when you go to a stock, now, when you look to CNBC or blogs, the first thing you'll hear is earnings, right? How much sales are they making? How much profit are they making? And it's kind of crap, because you'll find out when we talk about this and we look through this that those earnings are completely manipulated. Like we said, like we talked about earlier, that example from the software company that had started a $20 million partnership investment in NCR, which didn't go on the earnings statement, didn't hit them as an expense. And then miraculously, they had a new best friend. They got a $20 million contract from NCR like 2 weeks later that counted as sales, counted as higher earnings. So the average investor wouldn't put this together. They wouldn't see that, basically they're just moving money back and forth to make them look like they had more sales and more earnings. So this is what they do with the income statement. And when I talk about the income statement, let's look at there. I'll use Apple as an example today. It's not necessarily that Apple's trying to pull a lot of shady tricks or stuff. I just saw somebody. Where's the bow tie? Yeah, it's Sunday. I kind of got to relax. Okay. But what you'll see is so you look on the income statement, and the income statement is basically just all the profits that a company made over 3 months or over a year. Okay, so you start off with sales. Which is revenue, okay, and then you take off the cost of revenue, which is how much they paid for those raw materials and stuff. You take out operating expenses, which is all their staff and all the other stuff they spend on to run the company, and then you got some other stuff, and then finally you get down here to net income. And of course, that's everything you always hear on CNBC or on blogs is net income and earnings per share and price to earnings, and this is what's important, right? Well, when you find out when you actually do become an analyst or look at some of the stuff we'll look at today is it's bull. Okay, there are so many different ways for management to hide and manipulate and change these earnings that it's really almost kind of meaningless. So what we'll do is we'll look on a different statement here to really show show you what what we're looking at. But on this on this income statement, a lot of times you'll see companies recording sales or revenue before the contract is completed, or they'll defer expenses. So they'll they'll stretch their payments out to all their suppliers. Especially towards the end of the quarter, they'll stretch all their payments out so they don't they're not paying for a lot of their stuff, so they're not recording those expenses. Of course, so if you've got sales and you've got less expenses, less payments that you're not making your expenses, then you're going to have higher earnings. One notorious example of this is a lot of companies, and in the analyst community, we'll call it the 35-day month, because a lot of companies, and when you read into their reports or their financial statement reports, you'll see this. But it's a 35-day month because towards the end of the month, if they haven't hit their earnings numbers, they think, then they'll stretch that out. So they'll maybe cut off their reporting 3 or 5 days later, or even 10 days later, to make sure to get those revenues in. So when they do report those quarterly earnings, then of course they look much higher, and they beat those estimates that everybody's expecting. And a lot of times, even successful companies, they can actually manipulate earnings lower sometimes to make the next quarter or future quarters better. So conversely, they might not record a contract or sales that they had in the quarter. They'll wait to record it in the next quarter, or maybe they'll prepay a lot of their expenses in this quarter. And if they had a good quarter, they've already met their goals for that quarter, but they're a little bit worried about the future. So that's a lot of what we're going to be talking about today, finding those little tricks that they do. And one way you can find this, a little analyst secret that works 90% of the time. You always look at a company's press releases. And this is so funny because 9 times out of 10, when a company is caught pulling some of these shenanigans or some of these financial gimmicks or tricks, then they told you where to look for in the press release. As an example, is they'll put out a press release claiming how well they've done on a specific part of their financial statement. So maybe for months or for years or quarters, your receivables, the money that they booked as sales, they got these contracts from other people to pay them for goods and services, has been going up and up and up. So people are worried that they haven't been getting paid for these receivables. Well, then they'll send out a press release to the media, to the public, about, oh, hey, look, we lowered these so much, we collected on so many of these, we're doing great. And it's a warning flag. It's as an investor or as an analyst, you should just be saying thank you, because now you know exactly where to look. How were they able to get that number to change? Why are they pointing that out? And a lot of times it's it's some kind of financial trick that they tried playing, and we'll go in specifically into some of that pretty soon. So what you're looking for. We talked about the income statement a little bit, but what the real analysts actually look at is called this statement of cash flows. Okay, and why this is important, because that income statement is all accounting, right? It's you can record sales and revenue, whether you actually collect the money or not. You can there's a lot of things in that income statement that aren't necessarily happening in real life. They're just happening on paper. So obviously it lends itself to a lot of tricks and a lot of shenanigans pulled by companies. Well, the statement of cash flows is part of 3 financial statements that all publicly traded companies have to put out. This balance sheet, which is their assets, their liabilities, what they have and what they owe. The income statement, which shows, like I said, the revenue, the sales they had, and then all the way down to the earnings and profit for that quarter. And then the statement of cash flows. Now, why the statement of cash flows is important is because this is actual cash. Okay, and that's not to say that there aren't some sneaky ways that companies can trick this, but it is much harder to do than the income statement. You can't say so like we talked about in the income statement. If you've got a contract that pays out with another company for 3 years, right? There's some certain accounting differences where you can say, okay, well, we expect all of that to be paid within a month or two, so we're going to book that revenue now, or those receivables now. Whereas in reality, you're probably not going to get all of that money. maybe there's some terms in that contract where that the customer probably isn't going to come through with over 3 years. So maybe you can actually rely on 2 years worth of revenue on there. But you can book all that money on your income statement, and it makes that quarters or maybe those first few quarters of sales look really good. But there was no cash there, So what an analyst will do, he's first looking at that statement of cash flows and looking at where actual cash is coming in and how that kind of jives or doesn't jive up with the income statement. So we're going to be talking about how to match the two up and kind of how to look for some of the red flags. And the first way to do this, go into the statement real quick here because I don't want to put half of you to sleep. I know I kind of get excited about all this stuff because it's kind of where I'm from. Looking at the numbers and kind of being a financial detective on this, an investing detective. But I know it's not that way for everybody. But so the statement of cash flows is broken down into 3 sections. Okay, cash flows from operations is my favorite. Okay, this is some good stuff because this is actual cash the company makes from the business, which should be immediately obvious how important that is. Okay, this is actual cash generated from that business. This isn't investing tricks or debt tricks or anything like that. So that first section is really important. And what they do, they actually take net income here that they reported on their income statement, and then they add and subtract different things that aren't actually cash. Okay, so a lot of companies, especially the ones with like lots of equipment and stuff like that, will have a lot of depreciation. Okay, so they bought this building or this factory or whatever, 20 years ago, paid cash for it, and every year they get to pay money off of their sales to reduce taxes as depreciation, right? It makes their earnings look differently, better or worse. But it wasn't actual cash. So this cash flow from operations is just a way of saying, okay, you reported these earnings. You said you had this profit this quarter, but here's all the things that weren't actually cash. So how do we get back to how much cash you actually made in the quarter? So very important part there. Then you go a little bit further down, cash flows from investing. And a lot of this is usually, this is either asset sales, so a company that's selling parts of their business or assets like factories or that capital equipment that they have, or it's investments they're making in that kind of in businesses or acquiring other businesses. So this is important as well because if you see a company that's their cash flow is looking good, but it's because they're selling all parts of their business. Maybe it's a conglomerate with wind turbines and defense sectors and lots of different parts of the business, and they're just selling all kinds of those a lot of those assets off. Well, that might look great. That might help them pay their dividends and shore up some leverage and stuff, but you can't do that forever. So eventually you run out of assets and you can't make any more money. You run out of parts of your business. So that's an important section to look for. This purchase of investments. That's them buying assets and then sales of investments. So for example, here you see Apple invested $3.3 billion in the last quarter. I think this is showing quarterly. $3.3 billion in the last quarter buying equipment and stuff. They spent $7.5 billion. That was probably acquiring smaller companies, stuff like that. And then they sold almost $17 billion in other assets. Okay, and not necessarily to say they're selling businesses and stuff. They might just have investments, securities, stuff that are coming off their books and stuff. But so you can look into that. The last section here that we'll cover before we look at some of the tricks and some of the things you can look for is this cash flows from financing. And then so the last one was investments. Now this one is debt, and this one is going to be really important too because you'll find a lot of companies when they get in trouble, they just start issuing debt. They got this huge dividend that investors love, investors look forward to every quarter, but the business isn't doing so well. So they have to start issuing more and more debt to cover that dividend. They'll also, you'll see here also how much of the stock are they buying back, as well as how much money that dividend is paying. So all 3 sections here are very important. This last section down at the bottom is free cash flow, and that's really how much their operational cash flow, so that actual cash generated from running this business, minus kind of the money that it's called capital expenditure. It's the money that they have to spend kind of to keep the business running. Okay, they're buying different equipment, factories, businesses, whatever they need to buy to keep the company going. And then so your cash flow from your operations minus that is called free cash flow, and it's kind of a nice metric for, okay, what's left over. Say you got this company, they're making cash from the business minus whatever they need to keep that business running. What's left over for investors? Free cash flow. So that's an important one. And what you can do, okay, so this first metric we'll look at is called your CFO, which is your cash flow from operations. You compare that to EBITDA. Now, EBITDA is over on the income statement. So we've got cash flow from operations, right? And this, you get this from the net cash provided by operations, these numbers down here. Okay, so you're going to take one of those, and then you're going to go over the income statement. And what EBITDA is, it's called earnings before interest, taxes, depreciation. Basically, it's the company's earnings minus a lot of these non-cash things, right? Your interest. Interest is cash. Obviously, they have to pay that interest out, but we don't count it in that core business part of their earnings, right? This is basically their business earnings minus some of that financial tricks that they use in depreciation and tax gimmicks and stuff like that. And you'll find that on the income statement, usually at the very bottom, right? So for Apple, the cash flow from operations, I think this is quarterly. Let's go to yearly because it's best to look at these on yearly basis. So $77 billion Apple made just from the cash, collected cash for its business, $77 billion in the last year. And then you go down to EBITDA, and it made $87 billion in earnings. That's what it's reported in these earnings. So what you look at is that CFO number, that cash flows number, divided by EBITDA, divided by the earnings they're saying. And, optimally, you want these numbers about the same, right? You want them collecting the same amount of cash, or saying they collected this amount of cash and saying it's about the same as what they're reporting on earnings, what they're saying they earned as far as profits, And what happens, though, is, and most of the time, cash flow is a little bit less than EBITDA, because every company is going to use some financial tricks, right? Even Apple, that definitely doesn't need to use any financial tricks. Even Apple uses some of these just to make itself look a little bit better, right? So your earnings are going to be a little bit higher, right? So if you take cash flow from operations divided by EBITDA, then if they're even, it's going to be 1. If EBITDA, or the earnings they're reporting, is higher, then it's going to be less than 1, right? CFO divided by EBITDA. Now, what's that showing you is that, how far off are they trying to make their earnings look? Most companies, they want their earnings to be as high as possible every quarter, because that's what investors are looking for. That's what the analysts are looking for, the street. They want big blowout quarters, right? So they try every gimmick they can in the book to make this earnings, this EBITDA, look higher, right? Well, they can't fudge that cash flows. So they've got cash flows, which is saying one thing. They've collected this cash in the quarter. Then they've got EBITDA, that earnings, that's way higher. So it's just kind of a warning sign, right? If you see earnings so much higher than cash flow, okay, there's something I need to find here in these financial statements because something's not quite right. Another trick a lot of them will try to find, and this is a little bit deeper into the financial statements, is you'll see a lot of times they'll call it a provision for doubtful accounts. And this goes back to the receivables part that we talked about. Now, receivables are just, on the net income statement, and they don't break it down here, but basically, you've got sales that you signed the contract right now, and you paid and did all that, and then receivables where you did your service, you sold somebody some goods, but they haven't paid you yet, right? They're saying, okay, well, maybe we'll pay you over the next 3 months or 2 years or whatever. Well, what happens with a lot of companies when they get into trouble, they start letting their payers, their creditors slide a little bit, right? Or not creditors, but debtors, right? The people that took their services or took their goods, and haven't quite paid them yet, right? Now they reported that as sales, so that goes down as sales, and they can show investors that, hey, we had all these sales, we made all these earnings this quarter, but they didn't really collect that money. They collected. They showed on their income statement that they made the sale, business is doing great, and then receivables is where they kind of balance that. They say, okay, well, we recorded this as sales. We said we had the revenue, but they haven't paid us yet. So this is where we put this to kind of offset that and show investors what's really happening. Well, the problem is, and what you need to look for when you see this receivables is, receivables going up and up and up and up. Because what that means is a company is saying, okay, we don't care who we get sales from. We don't care if they want 3 years or 5 years to pay us. We need those sales. So they're going to be putting out terms for their customers, letting them slide for a lot of these. So they'll let terms go out, and obviously they're not going to collect a lot of this money. So all these sales that they've been saying that they had, it's just accounting gimmicks. Okay, so a lot of times you can look for higher receivables in that, or they'll call it the provision for doubtful accounts. Because another part of the financial reporting that they have to do, they have to say, hey, okay, we probably won't collect on some of these. This is how much we think we won't collect on these sales that we booked in these other quarters, and so that'll keep going up and up as well. Another thing you want to look for is the statement of cash flows. You just look at where that growth and where the money is coming from, and how they're paying some of these cash flows. So this is actually kind of what happened to Warren Buffett when he invested in IBM, and why that went so badly. Because the business wasn't doing so well. They had a huge dividend that they had to pay every quarter, and they had to start raising debt just to pay the dividend. And Warren Buffett's a genius, and he's got an army of analysts behind him, but nobody ever seemed to look at the statement of cash flows and looked at, okay, there's a problem here with all this debt, and they're just using debt to pay off the dividends. So what's going on here? So a lot of times you can look at the statement of cash flows, and you can look at the debt issued, debt repayment. So kind of how much debt are they collecting, or how much debt are they taking every year, and how much are they paying back, and then come down here to this common stock repurchases and dividends paid. So obviously, okay, Apple is buying back $72 billion of their own stock a year. They're paying almost $14 billion in dividends, but they're making that money in this cash flow from operations. So they've got good cash flow generation. What you want to look for, obviously, is companies paying out so much more in dividends, but they're not making that cash in the cash flow from operations. They're not actually generating that cash. So it's kind of a warning sign to look for as well, because obviously you can't do that for a long time. And if a lot of times what happens, like I said, every company uses these financial tricks and these shenanigans, but when they start getting in trouble, that urge or that pressure to do even more and more doubtful tricks or shenanigans or outright scams or frauds, it just rises. That pressure rises because investors want to see earnings every quarter and every year. So some of the warning signs that pressure is building is that they're paying out dividends, more dividends than they're collecting in cash. So they're going to be wanting to pull some of these. What else? So some other things that we want to look for. I want to get to your questions really quick. Now understand, we're just kind of looking at some of the tricks and some of the shenanigans a lot of companies will pull on their investors here. What I'm going to start doing is a series on videos on looking a little bit more detailed, a little bit more step by step into how to look at these financial statements, what to look for, and really how to do your own analysis. But I wanted to start you off with this live stream just for some bit parts of where to look really quick before you get that whole process. A lot of things we'll talk about is some of these income statement stuff. So we talked about the long-term receivables that you get that you see on the income statement, and a lot of times, like I said, they'll start booking those sales that aren't necessarily expected to be collected for more than a few months, or even further out, or the doubtful ones. The ones where, hey, we know that you're not going to make this whole 3-year contract. You're going to pay every quarter on this contract to us. And most of these contracts they end in 2 years, and nothing happens those 3 years. But we need to book some sales here, so we're gonna record this. So they start doing that, and you can look at some of these ideas, and a good example here is like companies that have two parts of their business. So for example, Apple sells hardware, in its phones and a lot of its products, and then future software and sales. Well, a lot of times what these companies can do is they say, okay, you know what? We know people that buy a phone, we know people that buy our hardware, they tend to buy this much in sales from our software and other services. So we're going to record that they can actually do this in accounting. They can record as sales, their estimate for a lot of these other services and software sales that they think they're going to get in the future from this customer. Okay, and it's an accounting gimmick, like we said. It's just numbers on a page. It's not real cash flow. But they can say, hey, we got this customer. We think, on average, he's going to bring in this much in sales over this period. So we're going to take some of those sales this quarter because we need the sales and we need the earnings to meet those estimates and those expectations. So just a lot of different ways people do this. A lot of people, if you're old like me, then you remember AOL. Back in pre-2000, in the 90s, was sending out all those little CDs, those discs of a free trial or downloading AOL onto your computer. And what they had said was, okay, we've got this, we just spent billions of dollars this quarter on sending these CDs out, but we're going to say, we're not going to say that this is an expense in this quarter, because that would have just destroyed their earnings, right? They paid out all this money for marketing in this one quarter or this year, and they wouldn't have had any earnings left over to show for it. So what they did, they said, okay, well, this is really a long-term marketing thing that we're doing. So we're going to take this and we're going to capitalize it. So we're not actually saying that we spent this money this quarter. We're going to say that we spent this money over years and years. So they take chunks of that spending that they did, and they just stretched it out over years. So they only needed to put down a very small part of what they actually spent in cash. They had to pay for all these CDs and sending them out and everything. They only put a small part of that on their income statement. So obviously, their earnings looked much higher, and investors were happy for a while until they figured out what they were actually doing. And then, of course, the bottom just dropped out of the stock because everybody realized, okay, you're saying that you're going to make so much more in sales than you're actually going to make from this marketing gimmick that you did. And your earnings aren't nearly as good as what you're saying they are. So that's kind of what we're looking at, and what we're going to be covering in the next couple of months. Kind of that process of looking at these financial statements, looking at some of those examples that happened in the past of how analysts found these gimmicks and these tricks that companies play. So we're gonna be covering that. Now I want to get to your questions and answer as many of those as we can. Feel free to ask a question that you had during the live stream. I'll try to go back and see if there was any here. Okay, Max. So mentioned futures in a few of your videos. I haven't seen a video dedicated. Okay, yeah, I am putting together a how to trade futures video for the channel. It's going to be kind of complicated because these are very complicated and risky investments. But I am putting that together on how to open a futures account, how to trade futures, and basically if you don't, futures are you see a lot of gold, metals. Energy futures, so crude oil. People will buy contracts to buy crude in the future. They'll pay, they'll contract for a certain price to pay in the future, and basically they're just saying, okay, I think the oil price of oil is going to go up over the next month or over the next 3 months, and I'm gonna play off of that. And basically, what it is, it's a hugely leveraged position because I can put down $1,000 on a contract on this investment and be able to invest in it's about 30 to 1 a lot of times in some of these. So I can invest in $30,000 worth of oil, barrels of oil. So you could see, I mean, even so, a 5% move. If you're 20 to 1 leverage, right? If you've got $1,000 and you invested in $20,000 worth of these contracts, then all your gains and losses are 20 times what you had. So a 5% move in that can be, that's 100%. 20 times 5 is 100. So you double your money if something goes up 5% in futures. Of course, if it goes down 5%, you just lost all your money as well. So there's definitely some risk there, but I am putting that futures trading video back together. Look at some of these others. You think the blogosphere is oversaturated? How niche do you have to niche? Good question, Drew. This is talking about some of the making money and the how to start a blog videos that we've run in the past couple of weeks. And I go to blogging conferences every year, and every year there's people that say, "Oh, blogging is dead. Blogging is too old. Move on to something else." And I mean, I didn't start my blogs until 2013, and here I am, 5 years, 6 years later, making 100,000 plus a year. And even in 2013, there was people saying blogging is dead. You can't make money blogging. You can't. And so I think the trick is to, like I've talked about, diversify your income sources. So you've got a blog, but you're making affiliates on there. You're doing sponsorship posts. You're doing your own products. So you're doing like self-publishing. You're reformatting your content for books. So you're not relying on just one income source. And then, like you talked about, niche. You obviously you don't want to talk about personal finance broadly. You want to talk about a part of personal finance, so budgeting or investing or making money, and you want to maybe talk about to a specific group, so millennials or military people or something like that, so you can become an authority for them. It's all about reaching a specific group of people intimately and personally, so that they rely on you and come back and you can build that community really. But blogging is certainly not dead. I would start a blog, but you have some of your other assets, like maybe a YouTube channel or some other stuff, and you'll always be able to make money on a blog. What else we got? 3 best tips for speculation. Simple tips if you could. Yeah, I don't even know what to say there. I mean, I can't, because speculate. If you're just talking about give me 3 stock tips, like you see on CNBC, well, what good does that do? It's not something that's going to help you find more stocks in the future. Even if I could tell you 3 stocks that are going to double in the next 3 months, so you do that, you make tons of money, and you're excited, you're confident, you're like, hey, I can do this, and then you pick 3 more stocks just out of the blue, and they all crash. So you really need to look at this fundamental analysis, this financial statement analysis. Learn how to pick stocks. Rather than just speculating and just kind of flipping a coin. It's the speculators that are losing their money, really, because you might have that 1 or 2 good picks, but then then you have nothing to go off of. So like we said in this live stream, pick 2 or 3 industries in which you have deep experience, deep professional knowledge, or you can build that knowledge just by reading, industry journals, magazines, stuff like that, to understand the industry, understand how it's competitive, and really be able to spot those best of breed companies in there, so you can find those stocks that are going to do better than their peers in that industry. You take the rest of your money, you just index it, you get broad market returns, and then you pick maybe 5 or 6 stocks within that industry that not speculating, that are going to do better. That's investing. Investing isn't turning on CNBC and getting what's that one show, Fast Money. Come on, it sounds sexy, but come on, how many people has that show actually ever helped? Just give me 5 stocks quick, in a minute. Sorry, I mean. Taylor's asked, how do you feel about using stop loss on your stocks? This is a popular question and one that we get asked just about every live stream. And yeah, honestly, we used to call them guaranteed loss orders. And if you don't know, so a stop loss is you buy a stock and then you immediately say to the platform, to your brokerage account, say, hey, if that stock goes down a certain amount, if it goes down to this amount, I want to sell it, right? Something obviously went wrong. I was wrong about the stock, and so I just want to sell it if it goes down to this point. Well, the problem is when stocks move up and down quite a bit, so more than 3 or 5% or so. So a lot of people set their stop loss at, they say, okay, if the stock goes down by 10% from where it is, I want to sell it because something's wrong, right? It just plunged by 10%. Well, what happens when most stocks, when they go down by that much, they go down by more. I mean, some news hit like a plane crash or something, or Elon Musk says something about the SEC again. So anyway, the stock will just crash, and it'll crash way through your stop loss. So maybe it'll go down 15 or 20%. And what happens is, it just immediately goes past your stop loss. It goes past that price, and there's nobody to buy your shares from you. It's just immediate. So basically, you get hit. It triggers your stop loss. So your brokerage says, okay, they wanted to sell it here. There wasn't anybody to buy it. Now the price is here, so we're going to sell it for down here. We're going to sell it for this 20% loss. Well, what happened is the market sees this news, it overreacts, because the market always overreacts. This is something we're going to talk about in tomorrow's video about the efficient market hypothesis and our 2019 portfolio update, and how the market is it's a market of humans, and they're batshit crazy all the time. Okay, so the market always overreacts. And what would have happened is if you didn't have this stop loss order, yeah, you would have woke up in the morning and oh my God, the stock's down 20%. That sucks. I just lost all this money. But it comes over the day, it comes back up a little bit, and then you can sell it, or then you can decide whether you still want this stock, whether you like it now, whether the financials are there, and that kind of thing. And then you make you make the decision, because a lot of this information, it goes immediately into stocks, and it's not something you can just set on this. What else we got? So don't listen to Cramer on Mad Money. I mean, I got a lot of respect for Cramer. Cramer was actually a great analyst, a great hedge fund analyst in his day, and he's kind of gone. He's kind of gone over the dark side, and because what do people want? People don't want to sit here and talk about financial statement analysis and the real work that goes in here. They want some guy leaning on a button that says buy, sell, and they want excitement, and they want hey, what do you think about this stock? What do you think about this stock? And quick stuff. So that's what sells. CNBC has to sell those ad spots. It has to sell brokerage. It has to sell a lot of stuff, and it's not going to do that by talking about cash flow statements and cash flow modeling. I don't have to worry about the money, so I just I talk about what I enjoy and what I think will make you a better investor. You can watch Cramer; it's interesting. I watch it every once in a while, but listen to what he says, some of the ideas and points, but don't just go jump out and buy the stocks he recommends. Go take the ideas that he has, the points that he makes, and then look at the stocks and maybe pick one out of every 10 shows that you hear, because he's jumping on 5 or 10 stocks an hour, and you just can't invest that much. So what else? What do we got here? What motivated you to start this channel? Well, a lot of thanks, Susan. A lot of it was just I've been blogging since 2013 and never really felt that face-to-face personal connection with with the blogs. It's hard to blogs. It's just writing on a page, right? So I started looking at YouTube, started looking at a lot of my friends, the financial bloggers that we've talked about, and that face-to-face connection they get with communities. I started the YouTube channel up, restarted it kind of in December 2017. So in 16 months, 63,000 people in the community here on Let's Talk Money. And that's 63,000 people that I get to talk with. I get to talk with people on the live streams here. And it's a good feeling because there is a financial crisis in America. What is it? 60% of people say they don't have enough money saved to cover a $1,000 emergency expense. The average 401k value is like $180,000. when people go to retire, which is like $1,000 a month on top of Social Security. There is a financial crisis in America, and I don't think it's quite hit yet how bad it is, and it's going to become. So it's kind of nice to be able to create this community. Help people with what I've learned over the last 10 years as an equity analyst and more as an investor, and really just kind of have that interaction. I won't tell you that the money's not good too. I make about $3,500 in ads that appear on the YouTube channel every month. I do right around $1,500 to $2,000 in sponsorships. Companies that I've worked with before, I like the products, like for example M1 Finance that I use for the stock market challenge. No fee investing saves you thousands. I like it, I use it, and I recommend it. And I get a commission every time somebody opens an account. So the money's good, but honestly, I did pretty well as an equity analyst. Wall Street guys make decent money. So it's just something that I can do and have some fun with and reach 63,000 people. It sounds weird to say it, but yeah, it's a great feeling to be able to connect face to face with a lot of people here. What do we got? What else? Foreign real estate company said has. Yeah, I don't. You'll have to. I don't know what foreign real estate company you're talking about. You'll have to give me a little bit more on that. What is your opinion on Harry Dent's? Oh, Harry. Okay, for a little bit. Okay, Chip. For a little bit, you said Harry Dent. I was thinking Batman. Oh, what's the Harvey Dent from Batman, Two-Face. You had me there for a little bit. No, Harry Dent. I'd have to read it again. I read his book a few years ago about the generational crisis coming. And I think, like I said, I'd have to read it again. I don't quite remember what he was talking about, but I mean, he's been pitching this dark crisis for probably about a decade or more. It started with the huge baby boomer apocalypse. So all the baby boomers were retiring. They were going to be taking their money out of investments. So you'd have stocks crashing. Typically older folks, older demographics, they don't spend as much. So consumer spending would be crashing. That would bring the economy down. So a lot of this really dark and scary stuff. It just hasn't materialized, right? What we see is a lot of with the millennials is the largest generation in history, and they're getting right into their prime spending ages and investing ages. So they're picking up what we're seeing coming off of the generation or the baby boomers. Excuse me. So yeah, the baby boomers they're taking money out of their investments. They're not spending quite as much, but the millennials are picking it right back up. So again, I'd have to kind of read back up on what Harry's saying, but. A lot of these guys, I mean, not so much Harry, because I haven't seen him a lot on CNBC or Bloomberg or a lot of these others, but a lot of these guys, they have to have the most extreme view because they want that press. They have to get funds for their hedge fund. So you got a lot of guys like I want to say Peter Schiff, a lot of these doom and gloom guys, Dr. Doom himself, Nouriel Roubini. I haven't seen him a lot lately because not all of his doom and gloom hasn't been coming true. You get these guys and they really suffer in a 10-year bull market because they keep hitting on these theories and people are only going to listen to them for so long and then say, you preached that over the last 10 years and nothing's happened. Boeing, Nick, yeah, Boeing is scary. I wouldn't touch Boeing, honestly. And I mean, first of all, it's kind of surprised me how resilient the stock has been. Okay, somebody actually, I think maybe it was last week or 2 weeks ago, it was right as that Ethiopian crash happened, and stock dropped down to about 370, 375. Somebody in the community bought it and thought they'd get it on the rebound, and it went pretty quickly back up to like 380 or so that day, and kind of stayed around there. And I said, what, the risk, what we don't know is just too much. It's not worth the risk, right? And now we find out that the pilots did everything right. They did what was in their manuals. They did what Boeing told them. It was the software. So now we're looking at Boeing, and they've got, over these last two crashes, they've got 300 people that died that they're pretty much responsible for. So we still don't know what the financial implications of that are. It's actually really surprised me that the stock is right around still, I think it's like 385, 390, something like that. So it surprised me that when a lot of that came out, that it hasn't come back down even more. So it's interesting that it hasn't sold off more than it has. I mean, I just can't call it a value stock at this point. I mean, nobody's talking about insolvency or they're dead or anything like that, and I don't think that they've got that kind of a problem. But it's kind of like AT&T. I see all these problems, all these question marks, and I don't see the return, the potential return in it. So yeah. If everything comes out roses for Boeing or for AT&T, then you might make an annualized 7-10% a year, or even as much as 11%. But that's kind of the upside, and you don't know the risks on the downside. The risks on the downside are much higher. If they're found, all these civil suits that are going to be coming out, they're going to be filed by families of these 300 people. There's a lot of downside there, and I mean there's just a lot of other stocks out there. You could still get that 10-12% upside and not have those big question marks. So yeah, I wouldn't necessarily touch Boeing right now. So what else we got? What do you think about REITs? Love REITs. REITs are I've got a retirement account, an IRA that is completely in REITs. I mean, I've got a lot of different accounts in different places, so it's not that all my retirement money is in REITs, but so real estate investment trust. But yeah, I've got one IRA that's completely in REITs. It's like $40,000-$50,000 in that one account, and because I mean, okay, well, I come from real estate, right? I started as a commercial real estate analyst in college. Worked in that professionally for a while, managed my own real estate portfolio. So I've kind of got a soft spot in my heart for real estate. You look at it, and no other asset has created as much generational wealth. We've got a president right now that owes his fortune to real estate, and his family's generational wealth in real estate. Okay, you don't often talk about that in stocks or bonds or a lot of other stuff. So real estate, I mean, it's just a great asset for building that long-term wealth. There's a lot of tax benefits, not only in REITs but in direct holdings of real estate. But one thing that a lot of investors don't look at with REITs is it's just a great way to take some of that stock market risk off the table. Okay, the last financial crisis was kind of an anomaly. It's kind of weird because it was a real estate crisis. But if you look back beyond that, these REITs, these real estate investment trusts, and specifically like the V&Q, the Vanguard Real Estate Trust that I recommend to everyone, they didn't, they weren't one-on-one with stocks. They didn't go down quite as much, and that. So if you've got 15-20% of your money, of your entire wealth in real estate, you have some in bonds, you have some in stocks, and it's really gonna level out those risks and that stock market volatility, that roller coaster that we all see in stocks. So definitely look for some REITs. As far as investing, I'd recommend the same strategy I use for the overall strategy, overall stocks, which is kind of like a core satellite strategy, right? So you have your core, whatever you're going to put in REITs in this broader real estate theme, put most of it in one or two funds. So maybe you've got the V&Q, which is the Vanguard Real Estate Fund, which is invested in U.S. real estate companies. You've got the it's a Vanguard International Real Estate Fund. It's like XUS. I can't remember the ticker right now, but look for that one, and that's going to give you real estate exposure outside the U.S. So you've got these two funds. You put most of your money in that. It's going to give you a broad exposure to real estate, and then maybe you pick out a few individual real estate investment trusts, like the DLR, which I think is Digital Realty. I own that one. It's a data centers real estate company. You own Ventas, which is I think I'd have to check the ticker on that. Ventas, it's like a healthcare real estate company. So you pick some really solid individual names. So yeah. Best dividend stocks to leave alone for the next 5 or 10 years. That's a great question. Actually, we talked about the videos that are coming up this Friday. We're talking about investing for the next 30 years. Okay, so these are companies that are going to be safe from a lot of these changes in the market. This is the macro themes I'm looking at. So I'm going to defer that question to that one. And it's really, yeah, it talks about how, how to invest, 3 ways to invest for even longer than 10 or 20 years, 20, 30 years, looking for, okay, companies that aren't going to be hit by the AI or automation, companies that actually have a tailwind, that are going to be driven by these demographic changes and all this this technology and stuff like that. Expecting buybacks soon or something like analysts. Yeah, I haven't talked much about buybacks. That might be some other channel. Last month, corporate stock buybacks. Saw your video in regards to gold. What do you think about inverse ETFs? Yeah, I don't do the leveraged or the inverse ETFs quite so much. More of a buy and hold or longer term investor. And what you see in a lot of these leveraged ETFs or the inverse ETFs, things like that, is they have to have derivatives. So they're buying futures and stuff in different ways to keep up this leverage or this inverse relationship, and that's just huge costs on the portfolio. So they end up being very expensive to hold. You can't hold them for the long term because those those expenses really weigh on returns. So they're short-term investments, and I don't use them a whole lot. So we're well over an hour here. I'm gonna kind of cut it off here. If I didn't get to your question, this video is going to process first. It usually takes about an hour to process and then show up on YouTube. Please ask your question in the comments. I read every single comment that I get and try to answer every single one. So ask your question, and I'll definitely get to that. Every week we're doing these Sundays, 1 p.m. Eastern. I appreciate everybody being here. Like I said, it's just fun to have this kind of face-to-face, and that's this community that we can build and really look at some of these stuff that are going to make us all a little bit richer. So until next week, I appreciate it. Thank you.